So this week is part 2 of our series, Buying Time, where we're going to lay out in a little bit more detail how we think about getting people through these bouts of volatility. And I'm going to share why I'm actually hoping we do see a correction in the US stock market. So with all the volatility that's picked up here in this month of August, we wanted to start the series called Buying Time. Last week, we looked at a lot of statistics that actually show a lot of positive things happening, whether it's corporate earnings picture beginning to brighten a little bit and showing that companies are successfully adjusting to the trade wars, to even some macroeconomic data that's beginning to trend in the right way. This week, we want to focus on how to buy more time as an investor. You cannot time the markets, but you can buy yourself enough time to have a successful investment, and that's what we want to get at. First, what we need to all avoid. Avoid headline news and scares. We've written about this before. If you're so interested, I can send you the white paper. The reality is we try to create narratives after the fact to justify the market conditions, but the studies that have been done show that 75% of market moves cannot be explained by headline news events. Okay, so that is when you saw, well, the Hong Kong protests send market down on Monday. Doubt it is the point of that. So we need to tune that out. We also need to tune out all the third parties in our lives, giving us their anecdotal evidence, experiences, success stories, failures. As the book Thinking Fast and Slow talks about, people are horrible with numbers in their head, and they're even worse when it comes to an emotionally charged subject like money and investing. And so, again, you don't know if they might be thinking they're telling the truth, but misremembering. They're making something up. They had a different time frame than you. They had a different risk tolerance than you. All those things need to be taken into account so you can stay the course with your plan and what you had set as your goals for your investment portfolio. How do you buy that time, though? I hear people, of course, say, I don't have time. I don't have time to ride this thing back out. This gets back to what we've told you all along. You need to build a portfolio that can sustain your needs independent of market returns, and that's quite possible. That's our whole high income series philosophy, and it works. Last year we saw across the globe dividends increase 10%, rental incomes increase in the real estate holdings, despite a year in which 90% of asset classes were negative. What does that do? Well, if you've got that check coming in the mail, so to speak, that can help you meet your needs, you don't have to sell off your asset even if its value is down. I've used this analogy before, bear with me, some of you have heard it. It's the milk cow analogy. We need to build you a portfolio that can give you the milk you need to survive. So here you've got this milk, it's this cow, it's giving you the milk you need to survive. And every day a crazy neighbor is going to walk by your house and yell out a price for your cow. The crazy neighbor, of course, is the stock market, and I think it is crazy that the world tries to reprice itself on a daily and even intraday basis. But if that cow is giving you what you need, what do you care what your crazy neighbor might be willing to pay for it at that given point in time? That is the same truth that can be true about a portfolio that's generating, again, enough income stream that you're not having to liquidate parts of your portfolio, which is how traditional investments have been built, to sustain your needs. If that's happening and your bucket's getting drawn down, now you have a problem. But that's not a prudent way to invest for those people who are needing that income and needing to buy that time. Once you've bought that time, you can get through these markets, whether it's the volatility, whether it's even a really steep decline like we saw in 08 or anything in between. You're now in a position to better yourself. If you're in the accumulation phase, you've got time, you've got age on your side, but you also have that ability to buy into that weakness, and that's your ability to use this to springboard to success. What you don't do, again, sell into weakness any more than you want to try to chase high-flying stocks. And how we think through it here is knowing those statistics about how very few drops become even worse, is we have probability weighted how far certain corrections usually will go. We have a neutral position for all of our portfolios. If we're in the neutral position, then we hold during periods of volatility like this until we get enough of a sell-off that we can use our conservative positions to buy down our stocks. Far from being something you have to fear, it actually becomes a tremendous opportunity to build wealth. The numbers are better for you with that type of volatility and a correction from time to time than if they've never happened. Why do we wait? Why don't we adjust more quickly in terms of reallocating? Because again, the statistics show that very few of those 5% drops are going to get bigger. And so if we tried to reallocate every time we had a 5% drop, we would move people out of their true risk tolerance, and we don't want that to happen either. So that's how we approach it. For us right now, we've got our trades on the ready. I know some of you will hate to hear me say this. I hope we get a correction here this fall. I'm optimistic about next year. I think it would be a tremendous buying opportunity to take us again from some of our neutral positioning across portfolio sets to something better. We won't buy anything. We buy what we like, but we've got those trades on the ready, and far from trying to run from volatility or hide from volatility, we're going to use it as a chance to help build real wealth for our clients. And so for those of you who are clients, we would just tell you, we're ready for this. We don't need to react now because we were proactively prepared. And the thing we will do is implement our plan if and when the market gives us those opportunities. But it isn't going to be based off trying to time the markets. It's not going to be based off what we think is our ability to predict the future. It's going to be based off sound investment philosophy that's based off historical facts and truths. So with that, we hope you take some solace in this. We will get through this. For those of you who may not be clients and want to have a second look or some help, of course, we're here for you as well. Thanks so much.